Hey everybody, back with another video, and today something a little bit different. I was sitting around thinking about the rising interest rates that are going to be coming this year and next year at the least, if not more, and thinking about what things we could look to invest in, what kind of ETFs, what kind of stocks, stuff like that. And I came back to what I always come back to, which is SCHD, which is what you guys have seen me use as a control and talk about a lot. And I thought about maybe what we could do to take that as a base fund and make it into a little bit of a better ETF. So I took SCHD, I screened out a good half of the stocks in there for a few reasons, and came down to something that we could probably look for as a better investment in a rising interest rate environment. When it came down to everything, I came to 37 tickers, 37 companies out of the roughly 80 that SCHD invests in. And, well, we're going to go over them right now. The first things that we got rid of were all financials, all banks, all insurance, everything like that. Anything that rising interest rates would affect in a substantial way in how they make money. With interest rates rising, that means that there should be less loans able to be originated because less people are going to be able to take out loans because the interest on that loans is going to become prohibitively expensive for some people. Now, will that actually happen? Don't know. If interest rates only rise a total of 1% over 2 or 3 years, it's not that big of a deal. However, if they rise 1% over a year, 2% over 2 years, stuff like that, then a lot of loans can start to not originate, stuff like that. Financials could take a big hit. If there's any kind of downturn in the economy, financials usually take one of the biggest hits. So we screened out all of our financials, which really took out about half of the companies in there. Another thing to note is because that we took out a bunch of financial companies, the PE of our new ETF is going to be a lot higher because financial companies generally have really low PEs when they're not in dire straits just because of the way that they handle their earnings. After that, we had to have positive short-term and total balance sheets. This actually didn't remove that many companies. I know it got rid of Pepsi because they have a short-term balance sheet issue. Their short-term assets are less than their short-term liabilities. And there might have been a couple other companies in there, but that was the only one that I can remember off the top of my head. The other thing is they have to all be currently profitable, so all of the companies do have positive earnings. No companies lost money over the previous 12 months combined. I removed Merck and Pfizer for obvious reasons that they really can't be evaluated because of the current virus situation. It's unable to really tell how their things will go in the future, where their money's going to be if there's any large changes in that situation. So just struck them because of that, just to keep things simple. Also got rid of Home Depot and Best Buy because of some woke policies that could be seriously detrimental in the future. Coke would have had that as well, but they did walk back their crazy thing a few months ago, so we did include them in the list. Again, that gave us 37 companies. For this, I equal weighted them. Everything here is between 2.3 and 3.2%. I would have made them even more equal weight, but I kept it very simple. Put $1,000 roughly in each, somewhere between $950 and $1,150 each, just because of I'm sorry, between about $950 and $1,200 each, just because the share price just made it that way. But we could even get this more equal weighted if I took this up to say 360,000 or 370,000 instead of 37,000. But I kept it simple, just $1,000 in each, just as an example. Of course, as you scale up, you could much more easily equal weight them. Now, actually looking over the diversification of the fund, we can see here that it is very well diversified, even with 37 companies only. Again, as I said, between 2.3 and 3.2% each. Everything from technology, industries, communication, even a little bit of energy, consumer defensive, healthcare, cyclical, and basic materials. All of the stocks here, they are paying a dividend because we are screening from SCHD, and we have a nice little breakdown here showing that the majority comes to what are considered sensitive sectors in communication, energy, industry, and technology, while about the other half of the fund is made up of cyclical and defensive holdings. So a very nice, very well diversified fund that we've created here. Again, everything very equally weighted, nothing crazy in that regard. when we compare the two funds between SCHD, which we have over here, with our what I'm calling better SCHD here, yield wise, in our better fund as we have, we're looking at about 3.5% dividend yield, while SCHD is currently paying, if we look at the trailing 12 months, 2.78%. If we look at the 30-day, about 2.9%. So let's say, between 2.75% and 3%. So we're doing about 0.5% better with our new fund. This is mostly because we've screened out a lot of banks that technically pay a dividend, but it's really tiny. So we've gotten about 0.5% better there. That's very nice. Looking at the beta, that is, how our ETF is going to perform when compared to the wide market. Our better fund does have a little bit lower beta, sitting at 0.73, while SCHD's, depending on where you're looking, here we have 0.82. It really does seem to be that might be over the last year, because the 5-month beta, the 6-month beta is sitting around 0.97, so it's very highly correlated to the market, whereas our better fund is about, a quarter, or I shouldn't say a quarter of a point, but is about 3/4 as correlated to the market as SCHD is. From the PE side, SCHD's current PE is about 17.5. This is from 3 months ago. The updated numbers, it's somewhere between 17 and 17.5. I haven't quite gone over the PE for our better fund, but it will be higher because, again, it screens out those banks that have those super low PEs because of how they handle their books. Next, we can go look at the growth and see how these will perform against each other. Starting with our better SCHD. Again, let's assume we're in a rising interest rate environment, and let's say, our dividend growth rate isn't particularly high, sitting about, 5%, and let's say that all of the fudders out there are right, and there's going to be flat growth over the next decade. Looking at 10 years, what could we think? What could we see here? We'd go from, our 37 up to about 54,000. Nothing too crazy there. If we do the same thing with SCHD, we go to our future value, check out SCHD. By the way, I'm using trackyourdividends.com, and I'm using the free version. Very useful site, even if you just use the free version like me. The paid version is even better. I have seen it. It's very nice, but this is a very good way of looking at your dividends and estimating future growth if you'd like to do so, as well as just building up your own pie chart and stuff like that. Let's do the same numbers for SCHD here. Say we get 5% dividend growth rate. Say we get 0% price appreciation over the next 10 years. What are we looking at? About 51,000. So, not a huge change, but, doing quite a bit better with our better version, just because the current yield is a little bit higher. Let's say, things do a bit better. Our dividend, let's say it's still about 5%, but we actually get some price appreciation there. Let's say we do a little bit better at 3%. For our fund, we already do quite a bit better, hitting just under 70,000. Whereas with SCHD, a little bit less than that, a few percent less than that. Now let's go big. Let's go out big term. Let's say 25 years here for both. Let's start with SCHD here. Let's say the dividend growth rate is pretty substantial. Let's say we're getting an 8% growth rate of our dividend. Let's say we do about, what the market expects to do over a long period of time, about 8%. We can see here almost $500,000. And that's just if you went with SCHD, which, is a very low cost fund, sitting at, 0.06%. You're not going to do bad by any means. But let's go to our better fund and see how we do there. Again, we're going out 25 years. Let's put in an 8% dividend growth rate, and let's put in an 8% appreciation. How do we do there? As we can see, we did 10% better. It doesn't seem like a lot, but that half a percent in your overall dividend gets you about more than 10% more money at the end of those 25 years. Of course, adjusted for inflation, that might not be as much as we would hope it would be. And of course, we're just guessing on these numbers. As we can see, the 5-year dividend growth rate for SCHD is about twice what our better fund is, but if you ask me, I would say that dividends are going to start growing a lot more slowly over the next decade, and I do think all of those people saying that we're looking at 0 or negative real returns over the next 10 years, they might have something they might be onto something there. With interest rates rising, the chances that returns are very, 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 very much lower than they were over the last decade or decade and a half. That's a very real possibility, so I would just keep that in mind. But again, just a little bit of a thought experiment. Try to screen out companies that would probably do worse in a rising interest rate environment, or if there was any real economic issues. Again, these are companies that if these rising interest rates lead to any kind of crash, any kind of correction, anything like that, all of the companies in here, they have good balance sheets. They all make money at the moment. We're equally weighted between everything. So, worst case scenario, you're going to lose money over the short term, but in the long term, all of these companies should continue to exist. They should continue to do well, things of that nature. So again, just a thought experiment, something fun to do. I hope you guys enjoyed it. I am going to be doing a lot more different videos like this, putting together portfolios, looking how things might do in the future based on some assumptions, stuff like that. Again, hope you enjoyed it, and I will see you next time.